about it with Tony Ciero. He's Vice President and Senior Portfolio Manager at Caldwell Securities. The tech stocks are back in vogue. First of all, thanks for being here.
Thank you, Paul.
The
Pleasure.
tech stocks are back in focus, just when we thought, as in the past, when they were edging out of the spotlight, here they are again, posting some very strong profit numbers. What do you think?
Absolutely, and one division like investors like is the cloud computing platforms, and that Azure brand-led Microsoft's cloud computing program, or Azure. It was what investors liked, up 33% quarter over quarter in terms of revenue growth. And that's been weighing on the investors' mind. Take you last year, back in June, Microsoft had a high above 460, and shortly after their earnings, its stock dropped about 15% because the cloud computing platform wasn't up to investors' expectations. But now it is, and here we are in the rise.
These companies perhaps are not directly tariff exposed, but they're certainly exposed to slowdowns in economic growth. And I think there had been some worry on Meta's, with respect to Meta, that perhaps its advertising numbers would soften a bit. We certainly did not see that, did we?
No, not at all. And you're right. Generally speaking, these software companies, tariffs won't have an impact, but it will have an impact on consumer demand on its products and spending out there. So we didn't see that with Meta, and also we didn't see that in Microsoft.
Were the Alphabet numbers of last week, were they a sign that maybe Meta was going to do well on the advertising line, because Alphabet certainly did?
Yeah, that definitely was a catalyst, and we could see a trend there. It seems when one does well, the trend will pick up as well. And as you mentioned before, we'll see later on Apple and Amazon report, and we believe they'll have strong earnings as well.
So let's talk about those two companies. Now, Apple, as somebody pointed out today in an earlier conversation, is fairly tariff exposed because the company does assemble and sell a physical product that crosses borders.
Yes, and apparently they got an exception from President Trump that their company won't be exposed, but we'll see. It's still a fear of unknown. We'll have to see guidance on that. If they change their guidance or come out with a negative, you can see the stock pressure come down. But in terms of growth, I think we'll be there going forward.
Are you concerned about the pace of iPhone sales at Apple? That's been a concern of the market that dates back to well prior to the tariff situation.
Yeah, absolutely. What's the latest, greatest product out there? So there could be a little bit of concern there. We don't necessarily have Apple as part of our portfolio. We're heavily anticipating Amazon's earning, and you can see Amazon directly as a relation to Microsoft, especially in the cloud computing platform.
Right.
What tariffs can hit Amazon, obviously, on the retail side, which is the e-commerce platform there.
Right. So what will you be watching for in those Amazon numbers?
Particularly how well the AWS, Amazon Web Services cloud computing platform, has done, and guidance going forward with terms CapEx spending. They committed something like $100 billion late last year to build up the infrastructure, data centers to house the energy needed for AI. So we'll see if that commitment is still going forward.
Okay, let's talk about Canadian stocks. They continue to outperform U.S. stocks, at least on an index basis. How much emphasis do you put on Canadian stocks in your client portfolios?
We do now, especially on the dividend side, and two reasons why. Well, it helps offset some of the growth stocks that you see in the U.S. Dividends are more stable here. And the second is yields, interest rates have come down drastically over the last year in Canada, down about 2%. And generally speaking, if you're a bond investor, a GIC investor, the current yields doesn't satisfy. So you're looking for dividend-paying stocks.
There's a 1 year, that's a 52-week comparison between the S&P TSX Composite Index and the S&P 500 in orange. Those numbers break out as follows. The S&P 500 over 52 weeks is actually up 12%. So that big gain it had in 2024 hasn't melted away just yet. The TSX Composite over 52 weeks is up 14%. So it outperforms, the TSX does, over 52 weeks. It also outperforms vastly over the year to date. The TSX a little bit above break even year to date. The S&P 500 down about 5% year to date. Royal Bank of Canada is your top Canadian holding.
Yes, a strong bank in terms of growth out of the major banks here in Canada. It has the projection of growth, and that's due to the merger with HSBC Canada late last year or early last year. Also, the dividend yield at 3.5%, very healthy, and we anticipate a growth in dividend of about 3% this year.
Okay, talk to us more about Canadian dividend pairs. What do you look for when you make a buy decision on a Canadian dividend pair?
Stable dividends and a stable business, obviously, those go hand in hand. and the propensity to grow dividends consistently time over time. So when you look at that, other names that come to mind are like the pipelines Enbridge, especially if the new government here in Canada turns on the taps, let's say, in Alberta. But for us to get coverage and exposure across our clients' portfolio, we look at an exchange-traded fund, XDIV, which is the iShares Canadian Quality Dividend ETF.
Right.
And there you get access to 20 good-paying dividend companies with the propensity to grow their dividends and be stable growth throughout time. It yields at about 4.5%, and does hold financials, so the Manulifes and Sun Lifes, but Royal Bank is the only bank of the top 5.
So a holder of this ETF, we're looking at it now, XDIV, receives a flow of dividend payments. Those dividends are not reinvested in the equities, they're actually paid out to the ETF holder,
Yeah,
correct?
monthly distribution, and on an annual basis, 4.5% current yield.
Okay, let's squeeze in Berkshire Hathaway, because I know that's another stock that you hold for clients, correct?
Yeah, and I've been on here many times talking about Berkshire Hathaway. And the reason is, well, you get the mind and manager Warren Buffett. And I wanted to bring it up because this weekend is the annual shareholders meeting in Iowa, I believe, or Omaha.
Yeah.
And it's widely anticipated that Mr. Buffett is going to announce his predecessor, and that being Greg Abel.
His successor.
Successor. And that being Greg Abel, a Canadian boy from Calgary.
Now, he's announced that in the past. Is it expected that Buffett will actually step down within a few days?
Yes,
okay.
That's what the expectation is. Yes, he's the co-chairman or vice chairman, and the anticipation that Buffett will step down and Greg Abel will take over.
How would you summarize what has made Warren Buffett so special as an investor over his many decades?
I'm going to say that private equity capability. He takes a position, he takes a stance. And we know his portfolio is not very well diversified. It's about 8 to 10 stocks in the US and a lot of concentration. But the other side, and I believe the side that's really done well, is the private equity. So names like Dairy Queen, there's an insurance company as well that just escapes me now, but it's the one with the lizard.
Right, Geico.
Geico, thank you. And that's just a cash machine. And that you get the steady growth of this private equity. Right. Long term, we're a big believer in private equity just because if you have the ability to lock in your portfolio, part of your portfolio for 10 plus years, let's say, you should anticipate a return higher than what the equity markets can give you. And having good private equity investments can potentially do that.
Tony, thanks for coming in.
Thank you.
Tony Ciero is Vice President and Senior Portfolio Manager at Caldwell Securities. Those are some of his thoughts on companies in the news and companies in his client portfolios. After the break, we'll get analyst reaction to MasterCard's latest results. It topped estimates. It looks like customers are still spending around the world. Next.